Hello and welcome to the Economics Pig at School podcast on trade, protectionism, exchange rates. It's one of the last topics we've got to do at A2 Economics before the exam. We've done lots of it already. I wanted to do a recap of some of the stuff we should already know. So if we start off with the balance of payments, the balance of payments is all financial economic transactions between one country and all others over a period of time, which is usually a year. It's split into the capital account and the current account. We only need to learn about the current account for our exam. The current account is split into 4 different sections: trading goods, trading services, income flows or investment incomes, and transfers. The trading goods might also be called visible, so that's obviously the things that you can touch, hold, your manufactured goods, your imported, exported food. The trade in services are the tertiary things that are provided, sold to other countries. Investment incomes or income flows is the flow of dividends and profits across back to the countries of the companies originate. And transfers is things like migrant workers sending money back, or aid where you pay for something or you give money but you don't get any corresponding good or service. For the UK, we've got a big deficit in goods, so we don't produce much of our own food. We don't manufacture many of our own goods, so most of those are imported. We've got a big surplus on trade in services. So for the UK, our big services is financial services. This week, the Chancellor Philip Hammond was talking about exempting financial services on the Brexit deal, or getting a good deal. That's because financial services gets the UK so much money, but also things like consultancy, marketing, insurance. For transfers, it's a slight minus, so that's mainly for the UK being a developed country paying out things like aid, but also migrant workers sending things back. And investment income is also at the moment in a deficit, so lots of companies that we've got in this country originate from abroad, so that money's going back. We've also got, on a very broad sense, or the basics, exports are things we sell abroad, so it's money coming into our country. Imports is when goods or services come into our country, but the money is from abroad. You don't need to know specifics in terms of numbers, but you need to know the general things that have been happening. So the UK has had a trade deficit for a very long time, so that we've been importing more than we've been exporting. The value of imports is greater than the value for exports. Examiners quite like to put the word volume in multiple choice questions, but it's value we're interested in. And if you've got a trade surplus, the value of exports is greater than the value of imports. Countries with the trade surplus, Germany in Europe, China, obviously quite famously have got a trade surplus, but also countries like Saudi Arabia and Norway because of oil sales, Russia because of gas sales. To go back to the exchange rate, that we've covered the exchange rate last year. The big thing to remember with exchange rate is that it's like any other market. So the value of your currency, the price of your currency, the price of currency in terms of another is the definition, but it's determined via demand and supply. So how many people want your currency is obviously going to push up the value of your currency if the demand is high. And if people don't demand your currency, then the currency is going to go down in value. If your currency goes up in value, that is an appreciation. It's where your currency goes up in value. It's a depreciation if your currency is falling in value. The reasons people will be demanding currency are to buy exports. So demand for a currency for the euro is going to go up if there's a big demand for German cars. For tourism, obviously that's probably the one that most students have had real interactions with. When you go abroad, you demand their currency. But one of the big things is due to hot money and speculation. So one of the biggest drivers of the UK's currency, the big depreciation after the Brexit vote, was because investors expected things like foreign direct investment to fall, UK trade to fall, so they sold off a lot of the currency. So the demand for the currency went down. So hot money, if you put money into another country to gain the interest, that is hot money. In terms of supply, the thing that determines the supply of a currency is from the central bank. So essentially quantitative easing and the money supply that we've done, narrow and broad money before. So we'll get onto this in a second, but quite famously over the years, China have manipulated their currency for the benefit of their trade. If you ever forget which way round the appreciation depreciations go, if you remember the acronym SPICED, so strong pound, imports cheap, exports dear. And obviously the flip side is true as well. So in the last couple of years, when the pound sterling has depreciated, that should mean exports go up because they're cheaper, they look cheaper to people abroad, and imports should go down because now it's more expensive to import. An easy evaluation point for that is a diagram that you will know called the J curve. So that shows that if the sum elasticities, the Marshall-Lerner condition, is if the elasticity of your demand and supply of your demand for imports and exports is inelastic, then a depreciation will worsen your balance of payments in the short run, and only in the long run will it recover. If you think it through, that should make sense, and this is what is currently happening in the UK, that our currency is depreciated. It doesn't suddenly mean that we're going to immediately go and buy UK-based products. It doesn't immediately mean that we might be tied into contracts for a year, 2 years, that people can immediately change it. So the J-curve shows a depreciation. After a depreciation, your balance payments will actually get worse. But in the long run, you're hoping that there might be some switching to internal products, domestic products, and that then the balance of payments will improve in the long run. In terms of protectionism, anything that tries to stop trade in any way, that you need to go for the most obvious or the best ones to explain. The one that lots of students forget for protectionism, how to improve your balance of payments, are supply side policies. So if we're looking at how to improve your balance of payments, your trade, if you've got a deficit, supply side policies are an excellent way for countries to improve their competitiveness. Obviously, if you think of the range of supply side policies, there's loads of them, but any form of supply side policy is going to push your productive capacity, LRAS, to the right. That lowers your prices and increases your output, so you've got more stuff to sell at a lower price, which should mean that people from abroad are more interested and want to buy your products more. The easy howevers to that are the howevers that you would use for supply side policy questions anyway. There's a time lag, they cost money, government failures, and any specific evaluation points for supply side policies you might talk about. So for protectionism, this is any way of trying to inhibit or stop trade, interfere with what's called comparative advantage. So comparative advantage is where one country is better off producing one set of products than the other. So if you've got absolute advantage in something, that means that you are better at producing products. So America has an absolute advantage in many things. It's better at agriculture, for example, than, say, Rwanda, sub-Saharan African countries. But comparative advantage says that doesn't mean America should focus on farming, because they have comparative advantage in things like financial services and marketing. Basically, they're better off specialising in things that they're going to get a greater return and more money from. So even though they're better at farming than Rwanda, America will focus on financial services, Rwanda will focus on farming, and then America will still buy up their produce, say, from Rwanda. So the things that interfere with comparative advantage are protectionist policies. This has been in the news in the last couple of weeks with Donald Trump and his proposed tariffs on steel and aluminium. So what it does is it basically puts a tax on the products coming into the country. So that will raise the cost to the consumer, but it will mean that steel producers keep their jobs in the Midwest of America. But there's a welfare loss for consumers because it raises prices for consumers. So this welfare loss is the big downside, the big evaluation. Other things are quotas, which is where you limit. You might only say you can only import 20 cars a week from a certain country. So that obviously just stops the foreign competition. But again, it probably means that there will be domestic switching to domestic producers, but they are probably less efficient than those. So again, there is a welfare loss. There's also a government failure and admin costs. So to impose quotas, tariffs involves government failure. One I mentioned earlier, there is currency manipulation. So China over the years have hugely manipulated their currency. So basically it's involved quantitative easing. China's had problems with inflation because of this. But if you think on a demand and supply diagram, if you increase the money supply. If you use quantitative easing, supply goes to the right. So the supply of the currency goes to the right, which means the price, the value of the currency falls. There's a depreciation, which means they should be able to export more because things look cheaper. The big downside to that is your obvious, however, is that, well, this harms imports. So the Chinese middle class or consumerism hasn't really got off the ground because they struggle to import things because it's quite expensive. Another one you can use is export subsidies. So if you give subsidies to domestic producers of things, that lowers their costs. Again, supply to the right, price down, it makes it look cheaper when you're selling it abroad. The obvious disadvantage is the cost, opportunity cost, budget deficit. In terms of the potential questions, there will almost certainly be at least one trade question out of the 5. So out of your 2 data responses, 3 essays that you can choose from, almost certainly one of those will be on trade. Quite often, the trade questions are not answered by many students. However, the students that do take on the trade questions often do a lot better in terms of average point scores. So bear that in mind. The general, so you should always simplify your questions. In general, the questions could be, is protectionism good or bad? So how they word it might be, is it only good for producers, consumers, the domestic country, etc. But essentially the premise of the question will be, is protectionism good or bad? In terms of recent events, that could manifest itself talking about the UK's trade options after Brexit. So are they going to have a free trade area, a customs union, or remain in the single market? But essentially it will be asking you what's good and bad about trade, about protectionism. So you would look at the specific policies that we've just discussed, but in trade questions you always need to say, however, if it interferes with comparative advantage, it's bad. You might get a question on essentially how to sort a current account deficit. So again, you go through the policies. It could be supply side policies, it could be to manipulate the exchange rate and protectionism, or it could be any other way to get demand down. So in the UK, we've got a high marginal propensity to consume. One way of getting our trade deficit down would be to lower incomes, but the obvious, however, there is you're lowering people's incomes. So always evaluate with those. And there might be a question of a 15 marker on an essay could be what determines the exchange rate. And remember, it's demand and supply. We demand things, currencies for export, tourism, hot money. Supply is the money supply. And a 25 marker likely question for an essay would be explain, evaluate, assess the likely impact on a country of a falling exchange rate or a appreciation in the exchange rate. You always use your obvious howevers. It depends on how long, it depends on the size of it. But then you always need to relate it to the UK. So if the exchange rate is going down, we should export more, import less. However, you've got the J curve. It takes time and the things I've just mentioned. So they're probably your 3 most likely questions. The 2 big diagrams you need to remember that could crop up in the multiple choice. You need to know the tariff diagram, where you've got the world supply being perfectly elastic. Tariff goes on, reduces the consumer surplus, increases the producer surplus. So you've got the welfare loss. Last year there was a question where you have to work out the numbers, so you need to be comfortable in what times what will get you the right answer. And the J curve. So you'd use the J curve in that last question I mentioned. So the J curve will come in if you're talking about appreciation or depreciation of a currency. Okay, that is all for our trade podcast.